You're watching Stock Watch with me, Ndauleng Lechela, and joining me to unpack your stock-related questions today is Jean Pierre Verster from Protea Capital Management. Nader from Benguela Global Fund Managers will be joining us in just a bit. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. JP, thanks so much for your time this evening and Happy New Year. It might be a new year, right? But similar themes, similar issues are still likely to move markets. The first full week of trade last week saw a flight to safety on the back, of course, of those geopolitical tensions. This week, we've got earnings, the U.S. inflation print, the Fed independence, and geopolitics still in focus. Let's just get your analysis, I guess, as we start on how markets have shaped up.
Yes, thanks, Ndauleng, and a Happy New Year to you and all the viewers as well. Mentioned a lot of very interesting and very complex influences on markets, and markets have responded by, as you say, first selling off, but then in the past year reaching new highs. Just yesterday and today was a new high in the S&P 500. So, so far so good. The AI march higher continues. A lot of stocks exposed to the AI theme have done pretty well so far this year. And defense stocks have done pretty well as things happened in Venezuela and Iran. So who knows what the rest of the year will bring for us. But it's been an interesting start to 2026. And yes, we don't know what's going to happen the rest of the year. But so far, a lot of the themes of 2025 have continued into 2026.
Grant, let's get your take now. Looking into your crystal ball, what's likely to shape markets in 2026, that is? Look at me.
Hi. Look, I think AI will remain a big theme, but I think what we've interestingly seen is a bit of movement into other sectors and other geographies. So that rest of the world over US, I think that continues. We see this volatile political environment in the US is going to continue to drive money into other areas where it's a bit cheaper. And perhaps you're already seeing it. It's not only AI stocks going up anymore. It's industrials, it's financials. Those are leading the way in Europe and the rest of the world. So there's earnings growth that's broadening out. And that's against a backdrop of so many headlines and so much noise. And as JP said, you know, between Venezuela, potentially there's going to be a strike in Iran. I mean, that's getting highly risky as well. But none of those are majorly economically sensitive unless there's an oil shock. So what I think broadly is that we're going to see a year of more volatility than last year. Yes, we had a massive volatile April, but outside of that, it was a pretty almost like one-way traffic for most of the year. And that's the surprising thing. We're going into those US elections this year, and there's more and more challenges to the Trump administration, whether it's tariffs, whether it's on some of the way they're carrying on some of his powers to commit acts of war. So I think the volatility is going to increase, not decrease.
Okay.
And I think you're going to see more of movement out of the dollar. Commodities remain well supported. Emerging markets will remain in favor as long as there's persistent dollar weakness and commodity strength. And you're going to see AI take hold in the broader global economy. Hopefully we start to see some of those much vaunted productivity gains to kick in. Because I think if we don't see that, those questions are going to be louder than they were last year. So where's the return? That question's going to get louder. And then those questions need to be answered. So you're going to see hits and misses from more and more companies as the investors demand more from the spend. So I think it's an interesting year. It's a year for active management for sure.
And talking volatility or lack thereof, JP, why does it seem like markets, traders are somewhat shrugging off those criminal charges against Fed Chair Jerome Powell?
Well, the gold price hasn't quite shrugged it off. The gold price spiked on the back of that announcement. And it really has only been gold. Equity markets haven't really responded. That could be because it actually increases pressure for the Fed to keep rates low or maybe cut them even sooner, which is, in the short term at least, good for equities. So that's why I didn't see a sell-off in equities, because this pressure, what Trump effectively wants to do indirectly, is to see lower interest rates and boost the stock market, which seems like it creates value for people, it creates wealth. But we do know that over the long term, having rates that are lower than what they otherwise should be does not create growth. It creates value in nominal terms, but it unleashes inflation, which means that you are actually poorer in real terms. And that is why gold has also increased. It's an indication that people are increasingly nervous about the real value of assets, even though the nominal value of assets are going up, because there's underlying inflation, which a lot of people thought might rear its head in 2025. It did not. And who knows, maybe 2026 is the year we see a little bit of inflation. And the gold price is telling us that some people are expecting.
And I mean, with some of those risks levied on the oil market, that could also filter through to inflation. You touched on gold there, JP, and there's a question for you around the yellow metal and whether you still are short on the gold miners.
So, yes, but I'll preface that because anyone who has been short gold miners the last year, you would have thought would have been carried out. And we still had double-digit returns in our South African fund, and we still had more than 30% return on our global fund. So the point of being short something and being wrong is that you can handle it as long as your position sizing is small enough. That's what we do. We keep small positions so that even when we are wrong, like in the case of gold miners, a year ago I also didn't like them, and I was wrong.
Yeah.
But it didn't hurt us too much because, thank goodness, we had European banks, we had semiconductor manufacturers, and they also went parabolic, and that offset some of the weakness that our funds experienced, the pain that the funds experienced because of being short gold miners. But keep your position sizing small, and that allows you to be wrong without getting hurt too much.
And let's get your take around the precious metals, Grant, and your positioning around those PGM counters, those gold counters. I mean, we started the year with prices higher. Gold hit a fresh record yesterday, trading above 4,600. Are you bullish on the precious metals?
So we have been bullish for probably well over a year now, certainly on gold, and we became bullish in platinum early last year. But I will say it's getting harder and harder, and the reason I say that is the way the price action is behaving. So if you look at the PGMs, you're getting these spikes, these parabolic moves. That's not fundamentally building, price action, positive price action. There's a stockpiling going on in China because they now have an exchange that's trading in the PGMs. And that's, I think, part of the reason you're seeing, and the speculation is coming to the table. So it's getting more and more difficult to stay long, to accept. I think we need to accept there's going to be more volatility. It's been a bit of a one-way ride.
Yeah.
I don't expect that to continue. Let me rather say that. As for gold, I think the fundamental structural underpin of gold has changed. And I think gold doesn't go back to 2,500. I think most gold miners are pricing in an average gold price significantly below where we're trading now. But that does not mean I think we go from here to 5, then to 6, and it's a straight line. I expect more pullbacks than we've already had in gold. And so that's probably going to continue. So it's going to be a bit of a bumpy ride. Structurally, I think you still need to hold gold in your portfolio given the global geopolitics. PGMs are more tactical, I would say, than fundamental. Gold, I would argue, is a little more fundamental from a portfolio point of view.
And just sticking with you, Grant, I'd like to get your thoughts around, the talk among analysts about a new commodity super cycle. We spoke about gold there, but I want us to focus particularly on the industrial metals. You touched on PGMs. What about copper, right? We've been seeing a lot of M&A activity around companies that own those assets.
There certainly are some indicators of a better cycle. So if you think of the liquidity in the system, global monetary liquidity is very high. You've got expansionary fiscal policy everywhere. You've got high debt levels everywhere. This is typically inflationary, and it's typically when in an inflationary environment or regime, you do find solace in hard commodities, in hard assets like commodities. So on a textbook type of look at it, that's supportive of commodities. But we have seen iron ore, for example, is not following the playbook of copper. But copper is being impacted by the tariffs in the US, leading to stockpiling there. There's a lot of noise. I think the structural fundamental supply-demand picture for copper is very bullish. There's a massive shortage over the next 5 to 10 years of copper, unless a lot more production comes online. You can't say the same for iron ore, but they do tend to move together. And so I'd say broadly positive on commodities. All the right factors are in place. Global economic growth is still fairly robust at 3.1%. Plus, you've got this monetary debasement playing out, and commodities are one of the places you need to be to hedge against those risks.
You know, Grant mentioned something quite interesting there about what we're seeing playing out in the iron ore price that's moving opposite what we are seeing in other metal prices. Where does this leave the likes of a BHP then, JP, when we are seeing, you know, so many miners, big miners, piling into more copper assets on the back of those demand-supply dynamics?
Yes, any mine who is basically focused on iron ore is thinking about their strategic priorities and their options to diversify away from iron ore. That's one of the reasons why Rio Tinto is having discussions with Glencore, and it's one of the reasons why BHP Billiton tried to acquire Anglo American. It's also a reason why Anglo American decided to rather merge with Teck, which is very copper heavy, because people would rather have, or mining executives would rather have exposure to copper than exposure to iron ore. So it does seem like the outlook for iron ore is not as strong as the other commodities, given that it's so tight, so strongly linked to the Chinese property market, with iron ore going into steel, which goes into Chinese property development. And people are nervous and think that maybe India would not pick up the slack if China does slow down to the extent we expect this year. We already saw it last year, a lot of Chinese developers under pressure. So yes, it's the one commodity where the fundamentals are not as strong as the other industrials.
Continuing our conversation around commodities and the miners, there's a question here on Sibanye. Is it a hold or a sell? That share price, of course, has been making gains, Grant. Some buying and suing as well. If I remember correctly, I think the PIC increased its stake a few months ago.
Sorry, I thought you were asking JP.
No.
Yeah, so look, it's basically, I think it's more than tripled from its lows. Definitely more than tripled from its lows, and probably tripled since the beginning of last year. Having said that, you need to formulate your view on the commodities, on the metals, because I can tell you that none of these companies are pricing in forward earnings based on current spot prices. The question is, are these current spot prices sustainable? It's not that obvious to me that they are in the PGMs. I think better prices than we've had is definitely sustainable. There's a slower adoption of EVs and all those good things, and the supply-demand factors favor a better bid under some of these prices. But Sibanye has become a lot less marginal. The US operations are becoming more profitable, especially with the prices where they are. It's a far better business than it was. Plus, it's got the gold kicker. I would say at these levels, I wouldn't be, we could probably have said this 20 Rand ago, but I think you've got to be reluctant to buy it here if it's your entry position. If you're perhaps a trader, you could think about it. If you're a fundamental investor, probably wait for a better entry level until you haven't had, these moves have been dramatic, and it will fall dramatically. Even if it's just a correction, it will be painful when it does that.
All right, let's give you another question then, JP. Mete, does it offer value at these levels? Has it reached its bottom? I think in the last set of numbers, we started seeing, some sort of turnaround efforts bearing fruit. Its debt levels, however, still, remain a concern.
Indeed. So the balance sheet is not in good shape. Debt levels are a concern. And then they got this big fine from the EU, this anti-competitive fine via the Rombat subsidiary that they own. And that's going to put further pressure on the balance sheet. So really tough position to be in. They are also closely linked to South Africa's vehicle production industry. And we know, look at last year, that the Chinese are importing vehicles that are better quality and a better price than any vehicles that are manufactured in South Africa. This is not just a South African phenomenon; it's a global phenomenon. Same is happening in Europe. Same is happening in the US, except for tariffs decreasing the impact. But China is globally the most competitive when it comes to manufacturing vehicles. And to have a small battery and other car parts manufacturer here on the southern tip of Africa, thinking that they can compete against the Chinese that have huge scale and are exporting all over the world, that is really tough. So we have the APVP, which is a government program trying to assist these types of companies like Mete. I know that there are hundreds of thousands of people employed in the vehicle manufacturing industry and associated industries that the government would be trying to protect. But at the end of the day, capitalism and the power of capitalism means that the best quality product at the lowest price is going to put pressure on everyone else. So I would see a clear of Mete because of this big trend that's definitely against.
Yeah, legislation, of course, and that master plan will probably take some time to implement, so those near-term pressures likely to weigh on Mete. Your thoughts around that company? You know, JP highlighting the pressure on its balance sheet. We also know that exposure it has to the SA auto market, Grant.
Yeah, I think the JP's spot on there. You know, with the difficult balance sheet in an environment that's hyper competitive against the Chinese manufacturers, they've got a tough road ahead of them. And you know, you need to really do your homework and understand how you think this company is going to drive those cash flows and pay down that balance sheet. Else you know, you need to be careful. There's a lot of disruption happening in the auto industry as a consequence of China, not just here but globally as well.
And sticking with you, Grant, a question here. Is it time to nibble into Mondi?
Well, it's a tough one. I thought it was time to nibble a few months ago, and it wasn't. But I will say that it's one of those. It's tied. These paper manufacturers are regionally tied. So you need the improvements in the paper and packaging pricing, and that's going to be driven by the economy in Europe. That cycle, that inventory cycle, which sees that increased demand and pricing power come through, it's been very slow to recover. There's probably some overcapacity in Europe, and Mondi, I think, has overcapitalized in some respects, which is uncharacteristic of them. So I think you could buy some, but I don't think you're going to see a rapid turnaround there. This seems to be now a longer game than I thought it would be. So nibble, put it away. It's offering value, but you need to. I think the cycle value realization game is going to take longer there than was expected by many already. So, yeah, be circumspect about it. That's my view.
JP, stacking up a Mondi against a Sappi, which would you have in your portfolio at the moment?
Neither. I'm not a big fan of either. Mondi's been under a lot of pressure, and historically it's been the higher quality company. But they have really been under pressure with what's happening in the paper versus pulp market, and they were forced to sell the Russian operations a few years ago. Sappi historically has been more cyclical, but the South African dissolving wood pulp business is really good, really strong, although it does not do well when the rand is strong. And the rand has strengthened a lot over the last year. So that has put pressure on Sappi as well. They've sort of put the European operations in a joint venture, trying to put that aside and ring fence that with the debt associated with that, so that it doesn't impact the rest of Sappi. That is some upside you have, because they seem to have de-risked the balance sheet through that deal. So Sappi looks interesting, but between the two versus any other stocks I can own, I wouldn't own either of them.
We have a question here from a viewer that's looking to rejig their portfolio, saying they're down 18% on Pick n Pay, up 24% on Super Group. Should I realize some loss in PNP, sell perhaps 50% shareholding, and invest in something like Super Group that is on an impressive upward trajectory, Grant?
You know, as an investment manager, I would have to say you shouldn't tie those two decisions together. You should look at each one on its merits. I think Pick n Pay is giving you access to Boxer, which I think is a good investment option. I don't necessarily love the Pick n Pay story. I think the turnaround is going to take longer than expected, and it's going to be tougher than expected. So look at it in its own right. I wouldn't say, and even if you do sell it, I wouldn't then necessarily just put it into Supergroup, because you already have that. And don't buy it because it's going up. Understand why it is you think you want to own Supergroup, which does look cheap and it has been improving, but they are very tied to the macro environment as well. They certainly, Pick n Pay is a staples. If you go and buy a Boxer, you're getting a much more defensive quality business. Supergroup is far more economically cyclical. It's going up now, and if things turn for the worse, it's not going to be very defensive in your portfolio. So I think you need to just look at them in isolation. I think Supergroup is cheap enough that you could buy it here into a macroeconomic recovery if you think that's coming, which, I mean, I think it is. And certainly in the UK, there's upside potential there as well as that macro outlook improves. Pick n Pay, yeah, as I said, it's not my favorite, but I like the Boxer part of it and the Pick n Pay clothing. You can probably hold that or migrate into another quality food retailer. That would be my strategy.
All right, let's move over to stock picks. JP, where are you seeing value at the moment?
Well, in Taoleng, it's the beginning of the year. It's back to school. We had the matric results in the past week. So aligned with that theme, I'm choosing Advitech. They obviously own a lot of schools. They own tertiary education facilities as well. A small resource, or a human resource business as well. They generate good returns, good cash. They've expanded into Africa. The demographics are very positive, both in South Africa and the rest of Africa. More children wanting quality education, and the parents working hard to pay up for the type of education that Advitech offers. And more people hopefully getting tertiary education, which Advitech also offers. So it's not too expensive, reasonably priced, very good business model, very good competitive position. That is why I would choose Advitech.
And what about you, Grant?
So I'm looking to build a more defensive element to the portfolio. And given what we talked about geopolitically, my pick is Lockheed Martin, the defense company. Now, we saw a lot of success in the defense companies last year, but mainly in Europe and Asia. And the US defense stocks actually lagged because all the new growth was coming in those other regions. I think we've seen a revitalization of that US defense sector. Lockheed makes the F-35s. They're very core to the US defense spending. You see them talking about upping their spending to $1.5 trillion potentially. They've got a very good order backlog. It's a quality business. There's a roadmap to unlocking growth in sales as they deliver on that order backlog, capturing some more of that margin. So it's a high quality defense player with a good position in the global landscape and in the US. So that's my pick, is Lockheed Martin.
Let's leave it there. Thank you so much for your time and sharing your insights with us this evening. That's all for Stockwatch. Thanks to my guests, Grant Nader from Benguela Global Fund Managers and Jean Pierre Verster from Protea Capital Management. Up next, it's The Close.